Okay. All right, so we're going to talk about calendar spreads. Sorry for the delay. I'm just waiting for the statistics on the channel to kick in, but they haven't for some reason. But in any event, this is about why you use a calendar spread strategy. Now, first of all, let me explain what a calendar spread is. Like other spreads, it has two legs, one where you go short and the other where you go long. But unlike most spreads, they have the exact same strike price. The difference is that they don't have the same expiration. So you'll be going short a near-term put or call. They also are of the same type. So let's just stick with put calendar spreads. So you would go short a near-term put spread of, say, a strike of, I have an example that I'm looking at right now of 347 on the SPY. And then you go long the exact same strike, 347, but for a further out date, expiration. Now this is interesting because what this type of strategy does for you, because you're going long and short on the same strike, it completely wipes out any of the intrinsic value. So there is no intrinsic value. You're dealing only with time value. Now, of course, it's time value as long as you stay within a certain range. Once you move outside of the range, then that value goes away. So a calendar spread generally wants you to sort of nail or pin the tail on the donkey, right? So you want to be able to have that the tent that is formed by it hovering right over your strike price. Now, it gives you it can give you a fairly wide berth in terms of the range of prices that you could be at, even with a near-term spread. Like, for instance, if you're using the SPY, we know that the SPY has intraday or intra-weekly expirations. So they have Monday, Wednesday, and Friday expirations every week. And so you could put one out, say, on, let's say today was Monday. You could put one, a short strike on Wednesday and a long strike on Friday. So they're very close together. And then now you have a couple of days up until Wednesday to execute the trade. Because past Wednesday, the short strike will go away. It'll expire, and you'll only be left with the long strike. So generally, you want to get rid of the entire spread by the time that the short strike, or before the short strike expires. Otherwise, you're left with a long option. In the case of the put spread, you'd be long a put. All right? So that means that you would have a bearish position on whatever you have, and that may be not desirable. Remember, we're in this spread just to collect the theta, or the extrinsic value, and that will increase very, very rapidly, and you can put that to your advantage. Now, the cool thing about calendar spreads is that if you miss on one calendar spread, you can always add another one. And particularly if you add them so that they're out of the money or far away from the current price, then the price of that calendar spread is very inexpensive. But what you can do is you can put multiple calendar spreads together so they create kind of like a profit tent. And now we did this with Boeing, and we're still in that trade, and I can demonstrate that. Let's go to the charts. So this is Boeing, and this is a trade that we've had on for a little bit, and it's actually comprised of two calendar spreads. These are a special type of calendar spread in that they turned into diagonals. But let's construct one with the SPY. All right, let's get rid of all these things. So SPY is currently at right here at about 328. Let's take a look at a chart of SPY. Just going to make this a little bit bigger so it's easier to see the SPY. Let's look at a day chart. So one thing I can say about SPY right now, if we're looking at a day chart like this one here, we're going sideways for a little while since the middle of the summer. With a lot of volatility though, up and down, but we're still going sideways. So if we expect that we're going to stay within that range, and we can define that range with a drawing. Let's do that. Let's this drawing sucks. Let's see, drawing tool. Channel. There we go. So we've created a channel. I don't know why that had to be so. The tools on Thinkorswim for drawing on charts are really poor. All right. So we have this range that we're dealing with here. We would want to create a spread that would encompass, this entire area here. So let's say that the middle of this is approximately where we're at now, say 333. We can analyze a trade for that. So we could go to a near dated spread, like let's say that we want something relatively near dated right after the election, say November 4th. Now we're a little bit low in that spread, right? So perhaps we choose something a little out of the money, or we can go a credit spread or call spread, right? And we're going to buy it a calendar. All right, so what it did was it went short a calendar at 332 and long a calendar at 332, but at 2 days later. So let's take a look at what that looks like. We have a lot of contracts on here. We'll go down to one single contract and minimize the cost. Man, what the hell is going on here? There we go. All right, so here we have a calendar spread. And as long as price stays in between these break evens, and it's a fairly wide berth from 324 all the way up to 340, so 16 points within the next 2 days. Let me show you what will happen to this spread as I advance the days. And if you look at the T0 line, it will grow. Now, of course, if you think we're going to move into this price, you may not want to center it right on here, because if you think price is moving around, let's say that we think that price is going to rise into the spread. So I might want to choose a strike that's to the right of where price is. Maybe at, I don't know, 335. Let's try 335. All right. Or we can go even further out. Let's say 340. So here we are, prices right here. And if we think that it's going to move in here, we really don't care about the cyan line. We only care about that purple line, which represents the intrinsic value. But if price is going to rise in here, it'll rise up on that slope, and it will get, and we'll be making money as we move to the right. And at the same time, we'll be making money. Let's advance one day. If you notice, no, it's not moving very much here. Normally this would move a lot. Let's make these much further out. I'll go to the 13th and the 6th. Okay. All right, so as we get closer to that date, you can see the intrinsic value rise. So this is assuming that we're working on that idea. Now, if you don't think that price is going to come up, and maybe you think that price you've missed and now price starts going down, well, what you could do is you could just add another spread over here to the left, maybe at 310. Let's do that. Let's add another one. I'll do a put this time, just to make things interesting. A put calendar spread. We'll buy a put calendar spread with the same dates and the same number of contracts. All right, so we're long the 13th and short the 6th. Now let's take a look at that. So now what we've done is we've actually spanned a range of dates, and we've created a big, huge profit tent. So we can be profitable anywhere inside of this. And we can keep on doing that. We can keep on adding these calendar spreads if we think we're going to miss as we get closer and closer to the date. And then we can profit from that. And that's exactly what we're doing with Boeing right now. We've been in this trade for quite some time, and Boeing has been moving sideways for a long time, and it's just now starting to move to the left. It's stayed in the center. So if we were to take a look at Boeing and its long-term view, let's see, BA. We can see that Boeing has been moving sideways for a long time. And so we had started out with Boeing with a credit spread that was down below, and then we added one above. We started out with a put spread down below, thinking that Boeing was going to move into it, and then it started to move away, so we added a call calendar spread above, and then we resulted in this wide profit tent. Now, this past day or few days, we've been moving down in price, and we've captured a lot of premium, about $100 in the middle. But as it's moving now down near the end of this, the life of the spread, it's moving into this left-hand tent, and we've actually got more profit ahead of us. So let's see, bring it down to present day. Here's present day. We're right here. We've made about $80. And then if we were to stay here or even move into the middle, we probably don't have much more to go in the middle, but if we were to move to either end, those will start growing. Let's see how prices, how it shapes and then forms into these two tents. That's a really powerful strategy. Very powerful strategy. Now, the mechanics of the way it works is not that important unless you're trying to really narrow in on a single spread. Generally, you want to make the best way to make money with the calendar spread is to place the strike price either a little bit north, a little bit south of the current price, wherever you think that it's going to go to, so that it can move into it. If it moves the other way, then you can put another spread on the other side of that directed move, and then now you've created this sort of what looks like a circus tent, and you've captured a wide range of prices. And wherever price moves, you could keep on doing this, but of course, if it just keeps on moving up or keeps on moving down, then you've kind of eliminated the biggest strength of the calendar spread, and that's trying to restrict it to or trying to capture it being restricted in a range. And maybe then it's time to start taking these off and consider a different strategy, perhaps a credit spread. But that's basically how you would use it. You would anticipate where it's going to go, either up or down, place that spread there, let it move into it. If it misses the mark, you can always adjust it, and you don't have to adjust the actual spread, but that's a possibility too. You could adjust the short leg, but you don't have to. The easier thing to do is simply to add another calendar spread and increase the size of this tent. Now, for instance, in the case of this Boeing, we're sitting here with just a couple of days until expiration. I could add, well, it's actually not a couple days, it's a 6/13, so it's a little further out. I could add another spread right where we are now. I could put it to the left or to the right, depending on where I think things are going to go. Now, if I were to look at Boeing right now, I'm looking at this thinking that, okay, we're probably going to stay inside of this channel. Let's create that regression channel. All right. We're probably going to stay somewhere inside this channel. We're slowly moving down, but I think we're going to start bouncing up soon. And if we do that, then if I wanted to put another spread on, I'd wait for that to kind of turn. And then maybe it's heading back to the middle of this spread. So maybe that's what I want to do. Maybe add another spread around the 155 to 160 area. So I have one set up here at 160. Now watch what happens when I add one at 160. I've changed the whole character of the spread now, so I've massively increased the intrinsic value area, the profit area under this, what now looks like a much more elaborate circus tent. All right? And so I've given myself even more opportunity to collect theta. So here's where it is now. Of course, the only thing I can collect is above the current line. All right? So if I put this spread on, I'm anticipating that it's going to go to the left. I mean, to the right, right? If it goes to the left, then I'm going to start losing. But not too long, because if it goes to the left as time progresses, you can see that the profit curve also progresses very quickly and can easily encompass any kind of move, kind of envelop, kind of take it over. So there's a little bit of strategy that you have to use here in order of the placement. You have to sort of anticipate where price might be going. If you're working with a long-lived channel, then you can kind of anticipate where it's going just by placing it at the edges of the channel and try to capture that theta decay. So this has been a very effective strategy. It doesn't cost a lot to put one of these spreads on compared to the amount of money that you can collect. In many cases, if you anticipate a larger move and you move it far enough away, you can actually have a very, very inexpensive spread on your hands compared to the potential value that it can return. So there is, as I said, a fair amount of complexity. But when you put on a calendar spread, the key thing to remember is that you are eliminating any of the intrinsic value because it gets canceled out with the long and the short at the same strike. But what you are doing is now you're focusing on the extrinsic value, and that is the premium, the time value. And you can anticipate whether it's going up or down and then place your spread to kind of capture that movement. And if you're wrong, that's not a big deal either. That's actually the strength of the strategy. You can envelop the possible moves left and right by adding another spread, maybe adding 2 more spreads. And now you've created a much wider tent that price can move within, and you can profit. All right, so those are the basics of using a calendar spread. Now, there are other things that you'd want to take into consideration, and this sort of goes along with it being best for sideways moving or channel moving assets. Relatively low volatility. High volatility, it's you'll get more premium, but it'll be more difficult to capture within a particular area. Don't ever limit yourself to just one calendar. You always have the option of adding more, unless it's a short enough lived calendar that you can take it off in a couple of days and it has a wide enough profit tent for you to have a high probability of profiting. All right. So we do have one question. So do you have certain scenarios where you prefer longer expirations and vice versa? Well, the longer the expiration, the greater potential profit that you can collect. Because as you go further and further out, the time value is greater and greater. So if you anticipate, and it could depend on the... sorry, hold on. It really depends on the asset that you're looking at. If it's a relatively stable asset, and I chose Boeing Airlines because I felt that it was any kind of airline was going to be relatively stable for a long time because, quite frankly, the airlines really aren't doing anything in this pandemic. They're going to experience very limited growth. And at the same time, the government is kind of propping them up. So that's one of the reasons why we're in the Boeing trade, for that reason. You might want to pick up like a consumer staple stock to do this on. Or once we've maybe hit a plateau, even on an index, or an industrialized ETF or something of that nature, where you don't expect to see huge movements. All of those are prime candidates for using calendar spreads. Now we can do it with SPY too, but here you're going to do it in the case where you don't expect a huge amount of movement. So then you would have to restrict the time, because if you were to expand the time, we know that SPY can move quite a bit over a long period of time. But of course, it will move in a smaller area in a shorter period of time. And again, you can always add a second or a third calendar to try to create a wide enough profit zone in the same way that you would do, say, with an iron condor. But this is a little bit simpler and a little easier to handle and manage, except for the fact that you have two different dates, and you have to be cognizant of the short date. The short date is the most important because that's the date that you're going to want to take the whole spread off, unless there's a real good reason to keep that long option on. All right? So that's that. That's the only reason why you would prefer a longer expiration if you felt that there was some advantage to collecting even more premium, and you had reasonable expectation that that asset is not going to make any large move up or down. But even if it does, you're still protected in that you could always add or add another calendar spread to it to kind of envelop or create bookends. All right. That's all I have to say about calendar spread. I think that the calendar spread is perhaps the best pure play that I've seen playing with options. And with a little bit of experience, some anticipation, some knowledge of the market, some good analysis, you can create an extremely profitable spread for very, very little cost. So the probability of profit actually for a single calendar spread is very low. But when you start adding multiple calendar spreads, it actually goes up very, very high, and at the same time giving you excellent return on capital, on the capital that you use. All right, that's all I've got to say about calendar spreads. I want to thank you very much for showing up, and we'll see you next video.